Yeah, about 15 seconds. You know what's noteworthy here is today's a big day. After the Fed meeting where we did nothing in terms of, we had a pause, ECB lowered, we're flirting with 4.5 and a 10 and 4 3/4 on a 30, and the data is hitting the wires. Let's start out with initial jobless claims, shall we? 207,000, well below the mark of 225,000 that we were looking at. 207,000 would be the smallest initial jobless claims number since the first week of the year when it was 203,000, and that was the lowest level going all the way back to February of 24. If we look at continuing claims, very fascinating. Continuing claims, 1,858,000. That's not a 34th consecutive month above 1.8 million. And something has changed. In the rearview mirror, we actually went from 1,899,000 to 1.9 million. Now, this is interesting. We haven't had a 1.9 million handle in 38 months on continuing claims. So this is a big deal. We want to monitor that, and we want to look now at our first look, as Andrew pointed out, on GDP for the fourth quarter, and the number comes in on the light side, 2.3%. We're looking for something a bit over 2.5%, sequentially under the 3.1%, which was rather robust last quarter. 2.3 would be the smallest since the first quarter of 24 when it was at 1.6. If we look at consumption, a big jump here. This is a strong number, 4.2%. That's a full percent more than we were expecting. That's 0.5% more than the rearview mirror at 3.7. 4.2 is the best since the first quarter of 23. That is something that's going to potentially push rates up a bit and argue against a slowing economy. On the price index, comes in on the light side. 2.2, we're expecting 2.5%. Now, even though it's better on an expectations level, it's still sequentially higher than the 1.9% in the rearview mirror. 2.2% equals the highest level of inflation in this regard since the second quarter of 24. And if we look at the core price index, that comes in at 2.5, exactly as expected. But once again, that's warmer than the rearview mirror at 2.2%. 2.5 would be the warmest, just like our last number there since the second quarter of last year. So we want to pay second quarter of this 2024. Now, as we look at all the data, the market really has to divine a lot of information here. Many look at expectations on anything that measures inflation, and usually on the day of trade, based on positioning, that ends up being more important. But in the macro view, and this is why many have gotten the Fed wrong, if you take a step back and just look at the numbers for what they are, they're still running a bit on the hot side with respect to pricing, and we're seeing some good numbers on initial claims. Maybe we're starting to run out of gas on the superlative performance on continuing claims. And as I said, 4.5%. Well, we haven't closed below 4.5% since the 12th of December. And if you look at a 2-year, it closed at current levels, would be the lowest yield close since about the second week of December. And finally, it's 4.5% in a 10. It's 4 3/4 on a 30. We haven't closed below that since the 20th of December. Andrew, back to you.